Hello, welcome to all of you. Today I am going to share with you about the economics and its related some important terminology. Without talking about the economics, nothing can be possible. Everything is related with the economics, financial condition. So first of all, what is economics? Various person can explain the economics in a various ways. So economics is the study of how individuals and society choose to utilize scarce resources to satisfy unlimited human wants. These wants encompass all the goods and services that individuals desire, including food, clothing, shelter, and anything else that enhances the quality of life. These wants are unlimited since we can always think of ways to improve our well being with more or better goods and services. However, to produce goods and services to satisfy these human wants, we need resources including labor, managerial talent, capital, and raw materials. All these resources thus are said to be scarce because their supply is limited in relation to their demand. All the economic agents face the problem of scarcity of resources, which necessitates choice. For example, households have limited incomes for satisfying their desires, so they must choose carefully how they allocate their spending among different goods and services. Business firms want to make the highest possible profit, but they must pay for their resources. So they carefully choose what to produce, how to produce, and for whom to produce. And the government also works with limited budget. So it must carefully choose which goals to pursue. Ultimately, economists study these decisions made by households, firms, and government to explain how our economic system operates, to forecast the future of our economy, and to suggest ways to make that future even better. Scarcity and choices are the fundamental concepts of economics. To examine these important concepts and issues, modern economists have divided the whole economic theories into two parts: microeconomics and macroeconomics. These words in economics were first used by Ragnar Frisch in 1933 AD. The terms micro has been derived from the Greek word mikros, which means small. Microeconomics therefore studies the economic behavior of individual decision makers, such as a consumer, a worker, a firm, or a manager. It also analyzes the behavior of individual households, industries, markets, labor unions, or trade associations. In contrast, the term macro has been derived from the Greek word macros, which means large. Macroeconomics thus analyzes how entire national economy performs, and a course in macroeconomics would examine aggregate levels of income and employment, the levels of interest rates and prices, the rate of inflation, and the nature of business cycles in a national economy. After this, I am going to share some of the related terminologies which is very beneficial or important when we are going to learn about the economics. First terminology I am going to present in front of you is scarcity. This is one of the important terminology which has been using frequently in the economics. Scarcity means the fundamental economic problem that arises because resources are limited while human wants are virtually unlimited. Second terminology is supply and demand, which means the relationship between the availability of a good or service or supply and the desire for it, that is demand. Prices tend to rise when demand exceeds supply and fall when supply exceeds demand. Third important terminology is opportunity cost, which means the value of the next best alternative that must be given up when a decision is made. Market. Market is an important terminology which means a place or system where buyers and sellers interact to exchange goods and services. Another important terminology is inflation, the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. GDP, gross domestic product, means the total monetary value of all finished goods and services produced within a country during a specific time period. Another important terminology is monetary policy. Actions taken by a nation's central bank to control the money supply, interest rates, and inflation. Next important terminology is fiscal policy. Government spending and tax policies used to influence a country's economy, that is called fiscal policy. Unemployment rate, the percentage of the labor force that is jobless and actively seeking work. Trade balance, the difference between the value of a country's exports and imports. A trade surplus occurs when exports exceed imports, and a trade deficit occurs when imports exceed exports. Next important economics related terminology is elasticity, which means the responsiveness of the quantity demanded or supplied of a good to a change in its price. Supply curve, a graph that shows the relationship between the price of a good and the quantity of it that producers are willing to supply. Demand curve, a graph showing the relationship between the price of a good and the quantity of it that consumers are willing to buy. Marginal utility, the additional satisfaction or benefit received from consuming one more unit of a good or service. Capital, goods that are used to produce other goods and services, such as machinery, buildings, and equipment. The next important economics related terminology is labor. Labor means human effort used in the production of goods and services, including both physical and mental work. The next term is profit. Profit means the financial gain obtained when the revenue from selling goods or services exceeds the costs associated with producing them. Equilibrium is next important terminology, which means the point where supply and demand curves intersect, meaning the quantity supplied equals the quantity demanded as at a particular price. Monopoly, a market structure where a single producer or seller controls the entire supply of a product or service, often leading to less competition. Externalities is another important terminology. Side effects or consequences of economic activities that affect third parties who did not choose to be involved in the activity. They can be positive, for example, education, or negative, means the pollution. The more terms, economic related terms are here, I am going to present is commodity. A commodity is a basic material or product which can be purchased in large quantities for the production of other goods and services. Commodities are incredibly important in ensuring many of our daily essentials are available to use. From crude oil used to warm our homes and fuel our cars to agricultural goods like wheat and corn to process into an array of food products for us to buy. Commodities really are essential to our everyday lives. Commodities can be bought and sold directly on the spot cash market or other derivatives such as futures and options. However, when they are traded on an exchange, commodities must also meet a minimum set of specific standards, which are also known as basis grade. The next terminology is equity. In finance, equity represents the ownership share of an asset or company. That is, if a company and all its assets were sold, equity represents the amount of money that would be returned to a company's shareholders. It is also known as shareholders' equity. We can think of equity as a portion of ownership in a firm or asset after subtracting any debts associated with that asset. It can be found on a company's balance sheet. The next important terminology is free market. This term is very important. The term free market is an economic system which is based on supply and demand with little to no government control, commonly referred to as a laissez-faire capitalist system. It is where people can buy and sell goods freely, and most companies and properties are not owned by the government. Overall, in a free market economy, the production of goods and services is usually determined by consumers and their patterns of spending. People are free to purchase how and what they want. With legal system is in place that protect property rights rather than determining purchasing power. Countries which currently operate with a free market include the United Kingdom, Australia, Canada, USA, and many other countries have applied the free market system. Another important terminology is Keynesian economics. Another important theory we shall often hear among economic terms is Keynesian economics, developed by the economist John Maynard Keynes. This macroeconomic theory is based on the idea that government intervention can stabilize an economy. Developed during the 1930s in an attempt to understand the causes and recovery of the Great Depression, Keynes spearheaded a revolution which overturned the then leading idea that free markets automatically provide full employment. He argued that aggregate demand of an economy, measured as the sum of spending by individuals, businesses, and governments, is the single most important dividing force in an economy. He added that an economy's output of goods and services is the sum of four factors: consumption, investment, government purchases, and net exports. And any increase in demand has to come from one of these. But during a recession, external forces often dampen demand, risking a reduction in spending and as such investment in business making these goods. According to Keynesian economics, to stabilize the economy, government intervention is required to moderate any growth and contraction within the market. After that, the another most important economics related terminology is macroeconomics. Macroeconomics is a particular branch of economics that examines the behavior and performance of an economy as a whole. Looking at a country's wider economic picture, it focuses on the aggregate changes in an economy, such as unemployment, growth rate, GDP, inflation, and more. As a field of study, it attempts to measure how well an economy is performing, understand what forces drive it, and how its performance can be improved. Researchers will look at two main areas: long term economic growth and performance in short term business cycle. Another important term is microeconomics. The opposite of macroeconomics is microeconomics, a branch of economics which examines the financial decision making process of individuals, households, and businesses. Generally, it applies to markets of goods and services, dealing with individual and economic issues, including what buying habits people have, what factors influence their choices, and how their decisions impact the goods markets in terms of price, supply, and demand. Essentially, it provides a more comprehensive understanding of market performance compared to macroeconomics. Microeconomics can help explain a whole range of financial queries we may have, including why some goods and services are valued higher than others and how we as individuals will respond to different prices. Now, the bull market. The bull market is another important terminology. In contrast to the term bear market, a bull market represents a much more positive outlook on a market's current performance, indicating that stock prices have either increased or are expected to rise soon. Generally, the term is used to refer to a stock market, but it can also be applied to anything that is traded, including bonds, currencies, and real estate. As with a bear market, the term is typically used to describe extended periods of time where securities are rising, mostly months or even years. This is because the prices of securities will often rise and fall during a trading period, sometimes multiple times a day. So, for a period of positive price increase, to be recognized, it needs to be sustained over a considerable period of time. Bear market is another important term in economics. In stock markets, the price of stock is generally a reflection of future prospects of cash flow and profit for companies. But when prospects begin to wane and expectation fall, prices of stock can start to decline. In these instances, the term bear market is used to describe this negativity or pessimistic outlook on a stock market's performance. Often, when prices face a prolonged decline, usually this term is used to describe when an overall market or index falls, but it can also be used to describe when individual securities prices fall at least 20% for a sustained period of time, typically up 2 months or more. When a bear market tends to occur, the amount of stocks that are sold tends to increase. Investors will often turn to short selling or put options to try and make money during a bear market. As prices fall, likewise, those with stocks invested in companies will often look to sell their stock to avoid losing significant value from their initial investment. Today this much only. Thank you for listening me. Don't forget to subscribe because your subscription, your likes, your views will inspire me to bring more such audio lessons which will be very beneficial for you. Thank you very much. Have a nice day.